If you were to design the absolute worst business model from scratch, you'd probably come up with something that looks exactly like a commercial airline.
Oh, yeah. I mean, historically speaking, it is a brilliant way to turn a massive fortune into a very small one.
Right. Because your primary assets cost like hundreds of millions of dollars each, and they depreciate the second you use them.
Exactly. And they require literal tons of explosive, highly priced volatile liquid just to operate.
Yeah.
Plus, your entire operation can be grounded by, a single snowstorm.
Or a random software glitch. It's an industry traditionally defined by commoditized products, zero pricing power, and just brutal capital intensity.
Brutal is the right word for it.
And yet, today, we are looking at a massive stack of financial research showing that Delta Airlines is somehow defying all those laws of economic gravity. So, okay, let's unpack this.
Yeah, the sources we have today are incredibly revealing.
They really are. We're looking at their Q1 2026 earnings report, their fiscal 2025 Form 10-K, and a very thorough deep dive value investing audit.
And our mission for this deep dive is to figure out how a company that, burns jet fuel for a living became a darling of Wall Street.
Right. And whether their stock, ticker symbol DAL, is actually trading at a discount right now for you, the listener.
Because we're really examining a fundamental transformation here. It's the story of how an airline stopped simply selling seats on a plane and engineered itself into a premium lifestyle brand.
A brand that generates massive amounts of cash. So I want to start with their most recent snapshot, Q1 of 2026.
Okay, let's do it.
Historically, the first quarter is usually pretty miserable for airlines, right? You have the post-holiday travel slump, unpredictable winter weather.
Yeah, Q1 is notoriously tough.
So considering those structural headwinds, how do they actually do?
Well, they completely blew past expectations. Despite serious industry headwinds, Delta posted a record March quarter adjusted operating revenue of $14.2 billion.
Wow.
Yeah, that is up almost 9.5% year over year.
Wait, so they're actually growing top-line revenue by almost 10% in the worst quarter of the year?
They are.
But did they actually make a profit? Because revenue doesn't mean much if your expenses are eating it all up.
They did. They beat Wall Street's earnings per share expectations, hitting 64 cents non-GAAP EPS,
Okay.
which is a 40% improvement over the same quarter the previous year. But now, if you dig into the GAAP net income on the report.
Yeah, I saw that negative number and honestly got total confused. How do you beat earnings expectations but officially post a massive loss?
Right. So that loss was driven by a non-cash mark-to-market adjustment of $550 million on their equity portfolios.
Okay, time out. Explain that to me like I'm 5. Why does an airline have an equity portfolio losing $500 million? Like, are they day trading on the side?
No, it's a great question, though. Airlines often hold stock in foreign partner airlines to solidify international alliances.
Oh, like route networks and stuff.
Exactly. And the value of those partner stocks fluctuates on the open market. So mark-to-market just means accounting rules force Delta to record those paper losses on their balance sheet right now.
I see.
But it's not operational cash burning.
Right.
I mean, they didn't write a check for $550 million.
Right.
When you strip away those paper fluctuations and look at the core operation of flying planes and selling tickets, the business is generating incredible amounts of cash.
Okay, that makes much more sense. And when we zoom out to their full fiscal year 2025 numbers from the 10K, that cash generation is just obvious. Over $63.3 billion in total operating revenue.
Yeah, which translated into an adjusted free cash flow of $4.6 billion.
That's huge.
It is. But the crucial part is what management decided to do with that capital.
Yeah.
They didn't just hoard the cash.
Or immediately blow it all on buying new planes to expand aggressively.
Right. They took $4.8 billion and actually paid down debt in 2025.
And they paid down another $1.6 billion in debt just in Q1 of 2026 alone, which brings their adjusted net debt down to around $13.5 billion. I mean, they are aggressively repairing the balance sheet.
They really are.
But here is the real aha moment for me in these sources. The top line revenue is huge, but where that revenue actually comes from completely shatters how I thought airlines worked.
Oh, the revenue mix is fascinating.
Because you assume an airline makes its money selling standard economy tickets, right? You search a travel site, find the cheapest fare, and buy it.
That's the traditional assumption, yeah.
But looking at Delta's revenue pie chart, only 40% of their revenue comes from the traditional main cabin.
And this is the pivotal shift. The legacy model of aviation was always a race to the bottom on price.
Right.
Because if you are just selling a seat from point A to point B, you are selling a pure commodity. Consumers will fight over a $10 difference.
Absolutely.
Delta intentionally shifted the paradigm away from that. 30% of their revenue now comes from premium products. So that's First Class, Delta One, Premium Select.
Right, these are the high-margin upgrades. And that segment grew 7% year over year in 2025.
Yep.
But the thing that truly blew my mind is the American Express loyalty program.
Oh, the credit card deal.
Yes. 13% of Delta's total revenue, which is $8.2 billion in 2025, comes from this co-branded credit card partnership.
It's massive.
They are acquiring over 1 million new cardholders every single year. But, how does that actually work mechanically? How does a credit card partnership make an airline $8 billion?
Well, it's an incredible financial mechanism. Essentially, Delta creates frequent flyer miles out of thin air.
Okay.
It's an unregulated proprietary currency. They sell those miles to American Express for billions of dollars in actual hard cash.
Wait, really? Amex just buys them?
Yes. And American Express then uses those miles to reward their credit card holders every time they buy groceries or gas.
Oh, wow.
So for Delta, they get huge, immediate cash infusions with virtually zero marginal cost to create the miles.
So what does this all mean? It's like Delta is actually a highly profitable credit card company and a luxury club that just happens to fly 1,300 airplanes on the side.
Exactly.
Oh.
What's fascinating here is how this specific revenue mix creates a massive economic moat.
Right, because they're totally diversified. I mean, add in the fact that they own their own oil refinery, Monroe Energy, which brings in another 10% of revenue.
Yeah, plus another 7% from maintenance and cargo operations.
It's a completely diversified ecosystem.
And because they aren't relying solely on budget-conscious leisure travelers, they command a unit revenue premium of approximately 115% relative to their legacy peers.
115%.
Yeah. When you have consumers eagerly swiping a Delta Amex for their daily coffee just to get lounge access, and business travelers insisting their companies book Delta for the premium experience, you completely insulate yourself from the pure price wars that usually destroy airline profit margins.
Okay, well, a premium brand and a credit card engine make for a great story. But surviving isn't the same as being bulletproof. Let's look at the actual physics of what they do.
The physical reality, yeah.
Because those 1,300 planes still require actual physical jet fuel to get off the ground. And when I look at the cost structure in this research, the turbulence gets very real very fast.
You definitely cannot escape the physical reality of the industry entirely. The operational costs are immense.
Take fuel, for instance. In Q1 2026, their adjusted fuel price was around $2.62 per gallon.
Right.
But the sources show that due to geopolitical conflicts in the Middle East, fuel is projected to spike to $4.30 per gallon in the second quarter.
Which is a huge jump.
The research notes this is going to create an estimated $2 billion headwind. Plus, you have random operational curveballs like that massive CrowdStrike technical outage we saw, which completely paralyzed the global network.
Yeah, and those are just the immediate cyclical threats.
Right.
If we look further out, the permanent long-term risks are arguably much heavier. By 2050, environmental regulations for net zero targets mandate a transition to sustainable aviation fuel, or SAF.
And from what I understand, SAF is incredibly expensive to produce and scale right now, right?
It is. It's not nearly as efficient as traditional jet fuel.
And it requires immense capital.
It's exactly. To prepare for the future and modernize the fleet, Delta already has a $28.5 billion backlog in aircraft purchase commitments.
That is a staggering amount of capital to have locked up. And it's not just the fleet, it's the people. Their costs are incredibly sticky. Labor is their absolute biggest expense.
Oh, without doubt.
They gave their frontline employees a 4% base pay bump in 2025. And then in February 2026, they paid out $1.3 billion in profit sharing.
Yeah, they really reward their people.
Which buys a lot of employee goodwill, sure. But I'm looking at this and thinking, if their variable costs like fuel are this volatile, and their fixed costs like labor and fleet upgrades are this incredibly sticky, aren't they just one geopolitical crisis away from their margins completely vaporizing?
Well, if we connect this to the bigger picture, we can see exactly how management has engineered shock absorbers into the company to prevent that exact vaporization.
Okay, what kind of shock absorbers?
Yes, fuel is volatile, but remember that Monroe Energy refinery you mentioned?
Right, the one bringing in 10% of their revenue.
It isn't just a side hustle. It actually acts as a specific physical hedge.
How so?
In Q1 2026, when refining margins spiked globally, that refinery provided a 6-cent per gallon benefit back to the airline, helping to blunt the impact of those rising costs.
Oh, I see. So when the price of refined jet fuel spikes on the open market, the profit their own refinery makes off those high prices essentially offsets the extra cost the airline side of the business has to pay to fly the planes.
Exactly. It's incredibly clever.
Wow, yeah.
They are hedging their biggest variable cost with a physical cash-generating asset. And regarding the fixed operational costs, Delta's ultimate defense is its real estate.
They're hubs, right?
Yeah, they have absolute dominance at key hub airports like Atlanta, Detroit, and Salt Lake City.
It's like playing Monopoly and owning all the hotels on Boardwalk and Park Place. Even if fewer people are rolling the dice during an economic recession, whoever does land there has no choice but to pay your premium.
That is a perfect analogy. I mean, you can't just start a new airline tomorrow and magically acquire 20 gates in Atlanta.
Right. It's impossible.
That infrastructure dominance creates a massive barrier to entry. It ensures that even in severe economic downturns, they maintain the flight volume necessary to cover those sticky labor costs.
Okay, so they've built this financial fortress to survive the bad times. But surviving isn't the same as being a great investment. Yet, looking at this research, the most risk-averse value investors on the planet are suddenly throwing billions at this stock.
Yeah, I assume you're referring to the Berkshire Hathaway move.
I am. In Q1 2026, Greg Abel, the CEO of Berkshire Hathaway, initiated a massive $2.65 billion investment in Delta,
It was a shocking move.
taking a 6.10% stake in the company at an estimated average price somewhere between $60 and $70 a share. And here's where it gets really interesting.
Yeah.
Berkshire is buying back into the exact trap they escaped, but the math shows it's a completely different company now. Because Warren Buffett notoriously liquidated Berkshire's entire airline portfolio at a loss during the 2020 pandemic, swearing off the industry.
Right, he was very vocal about the economics fundamentally changing.
So, does this signal a fundamental shift in how Wall Street views aviation? How does Delta actually stack up against strict value investing metrics today?
Well, this raises an important question. The research runs a rigorous value investing audit. And let's look at what Delta passes first.
Okay.
Their trailing 12-month price to earnings, or PE ratio, is a healthy 10.25.
Which is well under the traditional value ceiling of 15, so you're paying about $10 for every $1 of earnings.
Exactly. And their PEG ratio, which factors in growth, is an excellent 0.48.
Wow.
Yeah, legendary investor Peter Lynch always looked for a PEG under 1.0. Delta easily clears that. Plus, their interest coverage is strong. Their EBIT covers interest by 9.6 times.
Okay, so those are the passes. But hold on, let's talk about the downside, because when I look at this audit, they fail some pretty major historical tests.
They do.
Like a strict value investor typically looks for a price-to-book ratio of less than 1.5. Delta's is sitting up at 2.20.
Right.
Why is their price-to-book failing that threshold?
Because the 2020 pandemic travel suspension completely eroded their equity.
Oh, right.
Think about it. The planes were sitting on the ground generating zero revenue, but they still had to pay for leases, debt servicing, skeleton crews. They lost billions, hollowing out the book value.
Which also explains why they fail the consistency test for free cash flow, right?
Yes, exactly.
Because their historical free cash flow isn't perfectly consistent due to those dark pandemic years.
Right, but you have to understand the context. This is why institutional investors, who, by the way, own 87% of the stock right now, are making this move.
Okay.
They aren't looking backward at a once-in-a-century pandemic anomaly.
Yeah.
They aren't betting on commoditized seat sales. They are betting on Delta's aggressive deleveraging.
Like paying down that $1.6 billion in debt in Q1 alone.
Exactly. They are betting on its transformation into a cash-generating loyalty machine.
Okay, so we know smart money like Berkshire is buying, but we need to translate that into actionable insights for you, the listener. Is the stock actually on sale right now at its current price of $70.23?
Let's walk through the discounted cash flow, or DCF, valuation model from the sources.
Yeah, let's break that down.
It uses a 9.0% discount rate and starts with 2025's free cash flow of $3.843 billion.
Okay. And there are three scenarios, right? Let's walk through them. Scenario A is the no-growth case. What if travel just stagnates?
If travel stagnates, intrinsic value is calculated just $44.69.
So it's $70 today, you'd be overpaying. What about scenario B, the conservative 1.5% growth case?
In that environment, the intrinsic value sits at $57.41.
Still below the current trading price.
Right. Which brings us to scenario C, the nominal 4.5% growth case.
So assuming steady premium demand and the AMX expansion continues.
Exactly. In that scenario, the intrinsic value lands at $82.54.
Okay, the verdict. At $70.23, the stock trades at a 15% discount to that nominal value of $82.54.
Yes. The market is currently pricing in a very conservative outlook on fuel and capital reinvestment.
So, if you are a strict, ruthless value investor who demands a 30% margin of safety, you are sitting on your hands until this hits $57.78, right?
That is a very prudent strategy. Airlines remain high-quality cyclical operators. The smart play for a strict value investor is to monitor Delta closely and wait for a broader market drawdown to hit that 57.78 target.
Got it. So to summarize, Delta Airlines is basically a masterclass in decommoditizing a business.
Absolutely.
They took a metal tube flying through the sky and built a financial fortress using credit cards and luxury upgrades to survive the brutal physics and economics of the industry.
And, even if you never buy a single share of DAL, understanding this report really changes how you view every brand you interact with.
It really does. Are you buying a product, or are you part of a loyalty ecosystem that is actually funding the company?
Right. But before we wrap up, I want to leave the listener with one final lingering question built on the data.
Oh, yeah. The insider trading data.
Yes, because the sources show that while Berkshire is buying, corporate insiders at Delta have actually been selling millions in shares,
Wait, really? Like who?
like the retiring COO and president.
Wow.
So if Delta's true value is now so heavily anchored to the American Express loyalty program and consumer credit spending, what happens to this airline if the broader consumer debt bubble pops?
That's a scary thought.
Are we investing in an aviation company or a high-flying bank?
That is definitely something to mull over. Thank you all for joining us on this deep dive, and keep questioning the numbers behind the headlines.